The World Bank says Kenya's economy is heading for its worst performance since the COVID-19 pandemic back in 2020. The East African nation's 2024 economic growth
At first glance, this Nairobi suburb looks like any other. But its market tells a different story. Most of the stalls here are run by Congolese traders.
Numbers can tell surprising stories. Right now, one East African country is about to overtake its neighbor in a race for the region's economic crown. The IMF says Kenya will surpass Ethiopia in 2025, and the details behind this shift reveal a bigger picture of money, politics, and resilience. Kenya on track to overtake Ethiopia. The International Monetary Fund's latest projections show that by the end of 2025, Kenya's gross domestic product will reach about $132 billion, overtaking Ethiopia's forecast of $117 billion. This will mark the first time in years that Ethiopia is no longer the region's biggest economy. Ethiopia had enjoyed that title thanks to its massive population and state-driven investments in infrastructure. For more than a decade, Addis Ababa was seen as a model of rapid growth in Africa, with double-digit expansion rates in some years. But those gains have now been undermined by policy decisions, internal conflict, and mounting financial stress. Kenya, by contrast, has been quietly strengthening its position with a more open market approach, a diversified economy, and support from global investors. The IMF says this will make Nairobi East Africa's largest economy from 2025 onward, a symbolic shift that could also reshape the region's politics and trade. Ethiopia's challenges. The numbers behind Ethiopia's decline are stark. In 2024, the government devalued its currency, the birr, by more than 55%. That decision was necessary to unlock new support packages from international lenders, including $3.4 billion from the IMF and $16.6 billion from the World Bank. These funds are meant to stabilize the economy and help restructure debt. But the cost of devaluation has been heavy. Inflation has surged, imports have become much more expensive, and households are struggling to manage higher prices for basic goods. All of this is happening while Ethiopia continues to face the fallout of internal conflicts and severe climate disruptions that have damaged agriculture and displaced communities. Ethiopia's story shows how a once-celebrated growth model built on infrastructure and state-led spending can quickly become fragile when external shocks and domestic crises collide. Kenya's stronger performance. Kenya's performance in the same period tells a different story. In 2024, the Kenyan shilling became the world's best-performing currency, appreciating by 21% against the dollar. Analysts attributed this to a mix of successful financial management and strong inflows. The country raised $1.5 billion through a Eurobond issuance, which reassured investors about Kenya's ability to meet its obligations. Diaspora remittances also reached a record high of $4.94 billion, giving the economy extra foreign exchange support. Meanwhile, growth in agriculture and manufacturing provided resilience at home, even as global conditions remain challenging. This relative strength has helped Kenya attract confidence at a time when many emerging economies are struggling with debt and currency weakness. Domestic unrest and the finance bill. Still, Kenya has not been without turbulence. In 2024, the government introduced the controversial finance bill, which included sweeping new tax measures. The bill triggered massive public protests across major cities. Demonstrations were so intense that investors lost confidence, and the government eventually withdrew the bill. The protests also forced Kenya to pull out of a planned $3.6 billion four-year IMF program. That decision worried some economists who feared a loss of policy discipline. Yet, despite the unrest, Kenya's broader economy has remained stable, with a structure diversified enough to withstand shocks, global slowdown, and regional context. This resilience is notable given the wider global slowdown. The IMF has forecast that worldwide growth will fall from 3.3% in 2023 to 2.8% in 2024. Many developing countries have felt this slowdown sharply, but Kenya's diversified revenue streams and currency stability have helped it stay relatively steady. In East Africa, Kenya's rise stands out. Tanzania and Uganda are also growing, but their economies are much smaller in size. Ethiopia's troubles have opened the door for Nairobi to reclaim regional leadership, both economically and diplomatically. World Bank cuts Kenya's growth outlook. Even with these strengths, Kenya faces real risks. In June 2025, the World Bank cut its forecast for Kenya's growth in 2025 to 4.5%, down from earlier expectations. The downgrade came with warnings about rising debt, expensive borrowing, and weak private credit. Kenya's debt now stands at about 65.5% of GDP, a level that alarms both investors and economists. Heavy domestic borrowing by the government is crowding out the private sector, leaving businesses with little room to access cheap loans. In December 2024, private credit growth even declined by 1.4%, a troubling signal for an economy that depends on small and medium businesses to create jobs. Interest rates remain high, another obstacle for growth. While these rates help contain inflation and protect the shilling, they also make borrowing expensive for households and companies. The World Bank has cautioned that without stronger fiscal discipline and reforms, Kenya could find its growth constrained in the long run. The first quarter of 2025. Fresh data from the Kenya National Bureau of Statistics showed that in the first quarter of 2025, the economy grew by 4.9% year-on-year, almost identical to the same period in 2024. Agriculture and manufacturing were the main drivers, supported by good weather conditions that boosted both crop and animal production. All sectors of the economy recorded positive growth during the quarter under review, albeit in varying magnitudes, the Statistics Office said in its statement. However, the accommodation and food service sector, which had grown by an extraordinary 38.1% in early 2024, slowed sharply to just 4.1% growth. The information and communication sector also cooled, expanding 5.8% compared to 9.2% a year earlier. Financial and insurance activities grew 5.1%, down from 9.6% in the first quarter of 2024. Kenya's Ministry of Finance still expects growth to reach 5.3% in both 2025 and 2026, thanks to what it describes as a stable macroeconomic environment. Kenya's Optimism at TICAD in Japan. In August 2025, President William Ruto carried his message of optimism abroad. At the Japan-Africa Leaders Conference, or TICAD, held in Yokohama, Ruto said Kenya's economy is expected to expand by 5.6% this year. That number is more bullish than the forecasts of both the Finance Ministry and Central Bank. GDP is expected to grow 5.6% this year, despite global domestic headwinds arising from escalating tariffs and trade disruptions affecting many economies, Ruto said. His statement came just weeks after the United States under President Donald Trump introduced new tariffs that rattled global markets. At the same event, Kenya and Japan signed a new loan deal. The agreement is for a yen-denominated loan backed by Nippon Export and Investment Insurance, known as NEXI. While the detailed pricing was not disclosed, the insurance guarantee is designed to lower Kenya's borrowing costs by reducing risks for investors. Japan's expanding role in Kenya. The deal is part of a growing partnership between Nairobi and Tokyo. Back in February 2024, Kenya and NEXI signed an agreement to expand financial cooperation. Japan has already invested heavily in Kenya in areas such as power generation, road construction, and scientific research. The new yen loan will support infrastructure development and economic growth. Kenya's strategy is to diversify its funding sources, reducing reliance on traditional Western lenders while still keeping investor confidence. Côte d'Ivoire took a similar approach in July 2025, raising 50 billion yen through an ESG-certified samurai bond. Japan's increasing engagement with Africa is part of a larger strategy to strengthen ties across the continent. Kenya's monetary policy shift. Another key development in 2025 has been Kenya's monetary policy decisions. In August, the Central Bank of Kenya cut its benchmark interest rate to 9.5%, dropping below Uganda's 9.75% for the first time since 2023. Governor Kamau Thuge explained that the decision was aimed at stimulating bank lending to the private sector and supporting overall economic activity. Economists saw it as a sign that Nairobi is now prioritizing growth over strict inflation control. Kenya's inflation has remained below the 5% midpoint of the central bank's target range since June 2024, thanks to stable food prices, more predictable energy costs, and reduced exchange rate volatility. The bank expects inflation to peak at 5.2% in March 2025 before dropping below 5% again by June. Goldman Sachs senior economist Andrew Matheny has suggested that the rate could eventually fall further to a terminal level of around 8.5%, giving the economy an extra boost. Kenya versus Uganda. The interest rate comparison with Uganda highlights different approaches in East Africa. While Kenya has been actively cutting rates, Uganda has chosen to hold steady. Bank of Uganda Governor Michael Atingi Ego said core inflation is expected to remain around the medium-term target of 5%, and authorities see no urgent reason to change policy. Uganda's economy is projected to expand between 6% and 6.5% in the year through June 2026. By contrast, Kenya expects growth of 5.2% in 2025 and 5.4% in 2026. The two economies are pursuing different strategies, with Nairobi leaning on credit expansion to spur activity and Kampala choosing caution in the face of global uncertainties. Kenya's tourism boom in 2025. Kenya's economy is not only being reshaped by currency strength, exports, and partnerships. Another powerful force is tourism. According to new research from the World Travel and Tourism Council, the sector is set to inject a record $9.2 billion into the economy in 2025. That's more than 7% of national GDP, and it marks a 24% jump compared to 2019, before the pandemic disrupted global travel. This growth positions Kenya as one of Africa's strongest tourism destinations at a time when travelers are prioritizing authentic, nature-based experiences. Employment in the sector is equally important. Travel and tourism are expected to support 1.7 million jobs this year, representing over 8% of Kenya's entire workforce. That means almost 1 in every 12 jobs in the country will be linked to welcoming, hosting, or serving visitors. Meanwhile, domestic visitor spending is projected to reach nearly $4.3 billion, a new record, while international spending could top $2.3 billion, a rise of 31% since 2019. These numbers highlight not only the resilience of Kenya's coastlines, safari parks, and urban centers, but also the appeal of its culture and hospitality. The WTTC says Kenya has everything modern travelers want: nature, culture, authenticity, and strong infrastructure. Looking ahead to 2035, projections suggest the sector could grow even further, contributing $13.8 billion to the economy and supporting over 2.2 million jobs. That's 500,000 new opportunities within a decade, proving tourism is more than just leisure. It's a foundation for inclusive growth. Meanwhile, reflecting on 2024, Kenya's tourism already delivered $9.2 billion to the economy, with steady increases in both domestic and international spending. The stage is now set for 2025 to become a record-breaking year, reinforcing Kenya's leadership role in African tourism. Inflation, credit, and growth. Kenya's monetary easing is also a response to signs of weakness in the domestic economy. The Purchasing Managers Index compiled by S&P Global and Stanbic Holdings has been in contraction territory since May 2025, pointing to slower business activity. Sporadic anti-government protests have also disrupted the private sector. Lower rates are meant to break this cycle by making credit more affordable and encouraging investment. Churchill Ogutu of IC Group said the central bank is clearly signaling a pivot toward supporting private sector credit growth. Whether this will succeed depends on how quickly banks respond to the new incentives. Risks and opportunities. Kenya's road ahead is not without risks. Debt levels remain high, and the World Bank has warned that heavy borrowing could leave little space for development spending. Trade disruptions triggered by new U.S. tariffs add another layer of uncertainty. Extreme weather events are also a recurring challenge for Kenya's agriculture sector, a major employer and export earner. But there are opportunities too. The country's diversified economy, combined with strong diaspora remittances and foreign partnerships, gives it tools to navigate difficulties. Japan's support provides a new funding option, while lower interest rates could stimulate local business activity. What this means for East Africa. The IMF's forecast that Kenya will overtake Ethiopia is more than just a statistic. It signals a change in East Africa's economic landscape. Ethiopia's troubles have exposed weaknesses in its state-led model, while Kenya's mix of open markets, investor partnerships, and currency stability has positioned it to lead. For Nairobi, becoming the region's largest economy in 2025 will be both an opportunity and a responsibility. The challenge will be to use that position to drive regional integration, attract more investment, and continue reforms that make growth sustainable. So by the end of 2025, Kenya is expected to officially surpass Ethiopia as East Africa's largest economy with a GDP of $132 billion. But the path to that milestone is not straightforward. From debt pressures and global trade disputes to domestic protests and climate risks, Kenya must balance optimism with discipline. Still, the combination of new financing deals, lower interest rates, and resilient growth suggests the country is preparing itself for the next stage. For Ethiopia, the years ahead will be about stabilizing and rebuilding. For Kenya, the spotlight is shifting toward leadership. What do you think about this economic rivalry? Will Kenya's momentum last? Let us know your thoughts in the comments.